I thought I would just demonstrate a little of what I'm doing today. Today I'm looking at Hermes and trying to understand in a basic way what's going on with the company and what would the valuation be. So in order to do that, I open up the value model, and from the value model, I'm going to start at the top. You can see it's revenue down to profit, and I can see the prior period's revenue, and I can see down here on line 185, massive revenue growth in 2021, 22, down in 2023. So for right now, what I'm going to do is say that that's going to come down to 12. The the gross profit margin of the company is also massive, so I'm going to bring that down to 66 just to be conservative, and then let's say 65. And that's going to give me gross profit growth, from 50 to 30 to 19 down to 9, and then leveling out at 10. Now, sales, SG&A as a percent of sales, I'm going to say is 25% for right now. And below that, we have other operating items, but it's so small, as you can see on line 18, that I don't really care. So I'm not going to do much with that. You can see the EBIT margin is coming down a little bit, but basically at about 40. So pretty darn good business. This company is amazing. The interest rate paid, I'm going to raise to, let's say, 3.5, and the interest rate earned, I'm going to also raise. I'm just going to say 3, just to be safe. So now we can see the earnings before taxes. That's line 201, and that's giving me this line 23 up here. So I can see go from 2 to 3.5 to 4.7, 5.9, and then kind of somewhat flat growth. So now what I want to do next is I'm going to look at the other items, let's say income tax, and the company's paid about a 28% income tax, so why don't we put that in? And I'm going to, because the other items are so tiny, as you can see, equity, income, minority, and other items, I'm just going to leave them blank. No need to do anything fancy there. So what we can see is a net profit margin of 30%, one of the most profitable companies in the world. Now, margin isn't everything. What we also want to look at is the growth right here, which we can see growth was 76.5. This is growth in profit, down to 37.7, then 28, and then I'm going to say it's going to really fall, and then it's going to get back up to about 12, 13%. Okay, so now, because I'm going to try to do this as quickly as possible, I'm going to go down to the balance sheet now, and I'm going to look at cash. And cash has been about 79% of total assets. It's incredible how much cash this company is sitting on. So now let's continue and look at the receivables collections. Well, they don't really have much receivables, and the inventory is always going to be pretty high at the company. Now you can see it's gone from 160 to 200. But let's look over to here and see, yeah, it's been rising. So let's just pick 200 for right now and say that's the inventory conversion days. And then other assets, I'll just say, are 2%. Okay, so now we can see up here a total current asset line. And it's about the same on all the items. I'm not trying to get crazy here in my forecast because this is just a first pass through it. Okay, so next we're going to look at the long-term investments. Here we can see long-term investment is actually pretty small. So I don't really feel like I need to do that much here. If I wanted to, I could say, okay, there's going to be 50 million in investment every year. And, I'm going to say dividends received. Let's say this is, it's too high. So I'm going to come down to, let's say 10. All right. So that's dividends received. And also, I'm going to look at the growth in fixed assets. So fixed assets haven't been growing much. It's about 10%. So I'm going to say 10%. And then the average useful life is about 5 years. So it's very modern equipment. Now, that gives me some strange numbers up here. So you can see the accumulated depreciation. And so what I'm going to do is increase this to 10. and that's going to reduce the amount of this charge. Now, it gets a little complicated here because we have other changes in accumulated depreciation right here. And so what we really need to look at is the sum of these two. And the sum of these two, we can see, is 368. The sum of this, negative 368. The sum of this is negative 422. So what I really have to do, because I don't forecast these other ones, I actually have to keep this pretty low. So I'm going to go and say, let's say 7. What happens? Oops, sorry. I wanted to go 12. Yeah, so let's say roughly 12 is fine. And then growth in assets under construction here, it's a small item, but I'll just grow it at 10%. Kind of in line with, what's been happening with the total assets. Okay, so now I'm looking at goodwill and intangibles. So we can see that we can say new intangibles as a percent of beginning intangibles. So I'll put a number in there, just increase it a little bit. 13% is the rate as a percent, and that will increase this number. And then we have some amortization charge. So we have a year utilization, which let's say is, I'm going to bring it down just to 8 there. Okay. And maybe I'm going to bring that up to 10. And when I bring it up to 10, this is, very small or slowing. And therefore, we can see some growth in intangible assets. But it's a small item, so I don't really care that much. And then goodwill is something that's kind of sat there for a while, so I'm not going to make any change. And then when it comes to long-term asset growth, I'm just going to look at what's my asset growth expectation right here. It's pretty high. So I'm going to say 5% right now. All right, so that gives me my total asset growth. Now, the asset growth gets big up here, 20% on average. And we can see that the revenue per asset is actually shrinking, meaning we're growing assets pretty fast. Return on assets, therefore, is coming down. So we'll look at the liability side of the balance sheet for a moment just to think about that. So first thing is current portion of long-term debt. Long-term debt for them is just tiny, so I'm just going to put that there. And payable days, let's just say 60 days. We can look over to the right and try to see, it's 52. So let's just say 55. Maybe that's a little bit more reasonable. And then other current liabilities as a percent of sales. It's not necessarily a traditional way. Other analysts may do it a different way, but for me, that's the way I do it. And so that would give us the other current liabilities as a percent of sales, which is this particular item. It's actually relatively big because the company's doesn't really have any borrowing or other items. All right, let's look at long-term borrowing. Well, the total amount of long-term debt we can see hasn't really changed. And we can, I'm just going to leave, let's say, an assumption of long-term debt growing at 5%. And other long-term liabilities also 5%. Now, the next thing is to look at what's happening with the dividend payout ratio. And so here we should have that dividend payout ratio. It's been pretty high for them. They did a special dividend in 2023. So let's just go back to 40% dividend payout ratio. And that gives us a return on common equity of about 27%, going down a bit. And also, if we go back up to the number that I was looking at before, let's look at, the net profit growth. We can see 3, then 10, 12. Okay, so that's slowed down a bit. I would say that is a good enough forecast to be able to go to the discount val and try to understand what we should expect here. So here we can see that the market risk-free rate in France has been, over the past 10 years, it's been 1%. But I'm going to say we're looking forward. So I'm going to use, 3%. And equity or premium has been 4, but I'm going to say 6. That's going to give us a return of about 9% for the market. Now, that's the expected market return. And then the beta of this company has been pretty close, let's say, to 1. So I'm going to leave it at 1. And that means we're going to use a discount rate of 9%. Now, I'm going to keep the cost of debt at about 3% and then the tax rate at 28%. So if 3.5% cost of debt and a tax rate of 28 and after-tax cost of debt of 2.5. But truthfully, it doesn't matter because debt is really nothing in the capital structure. I will increase it just a little bit to 5% just to say maybe something will change. And therefore, our cost of equity of 9% and our weighted average cost of capital of 8.7 are almost identical. Now I'm going to fade the invested capital or the return on invested capital down from where it is. And so I'm going to fade it over 10 years because it's exceptionally high. In fact, this is a weird company because it has so much cash. Its return on invested capital is massive. So is it going to fall from 90, which I'm forecasting for the discrete period, down to 8? No, that's not likely. So let's just put it at a 500% premium. Now, when I say premium, that means 52 divided by 8.7, and that would be a 500% premium. And so here we can see that 52. So that would mean on the chart on the right, we can see the invested capital, the return on invested capital going from 100 to 50. So cutting in half, but still a highly profitable business. I'm going to take the growth rate and bring it to 3%, let's say, for the long term. And then dividend at the final fade year, I'm just going to say 40, which I've forecasted before. And so now I can get a picture of the value that I'm putting on the company right now. And that value is equity value per share of about 780 versus the stock price of 2301, which gives me a downside of 66%. That would tell me, based upon a free cash flow model, that the company is overvalued massively. Now, there are other models down here. We have the dividend discount model, which is really measuring the value of the discounts, the dividend stream. And here we can see, though, it's still pretty overvalued. And then we can look at residual income model. And on that, it's a little bit more, in line. But any of those free cash flow calculations will give you a massive downside. Now, a big reason for that is because of the, let's see if I can see it here, invested capital. We can see that the company in 2023, let's pick 2023, and we're looking at the invested capital. We can see total debt, a small amount of debt, and then equity and minorities, 15 billion euros, and then all this cash that we reduced. So our invested capital is only 5,297 because the company is holding almost 70% in cash. And so with such a low return or invested capital level, then that return on opening invested capital is massive. We're talking about 50 to 100%. And so it can be a bit distorting. Now let's look at the multiple val sheet here just to understand the multiples. And what we can see from this chart is that the company did trade on some massive multiples of 70 or 80 times up here, which is more than 2 standard deviations above the average since 2015. It's down now to about 30 times according to this. Now, I would say there's still some doubt I have there about that chart because as you can see, the multiple is about 50 roughly here. So I'm not exactly sure what's happening with this chart, but this is trailing PE that we're pulling from data, and this is just coming from the model. So we're pulling this from Refinitiv, so it can be different. And when you do see something different, you got to ask some questions. But let's now look at the price to book. And here we can see price to book at 2023 was 15.9, which is about what it says on this chart, which is only 1 standard deviation from the long-term average of 12 times. And why does it get such a high price to book? Well, because the return on equity is double the industry average in France and maybe even triple the industry average in Asia and then double world average. And so therefore, I think you could say that on a price to book basis, it doesn't look unreasonable, but it is a bit expensive. And then if we look at the EV to EBITDA right now, it's about 32 times. So based upon all of that, what I would say is that Hermes, how long did this take? It took 15 minutes. That's the goal for me with my students, is to get 15 minutes, value a company, and get a basic understanding. Now, if we are looking in this company in much more detail, we've got to put a lot of meat down on what it is that is supporting our assumptions. But for right now, all I wanted to do is get a basic understanding. So hopefully that helps.